Hello and welcome to BQ Prime. Joining us today is Happiest Minds CFO Venkatraman Narayanan and Executive Vice President Joseph Anantharaju. They are speaking to us after Happiest Minds Q4 results, where revenue was up 3% sequentially, but profit was flat. For the full year, revenue rose 23.7%, while profit was up 27.5%. Operational profitability improved by 28.9%. Good morning, gentlemen. First of all, congratulations for the quarterly results. My first question is to you, Mr. Venkat. In the statement that came with the earnings, Mr. Ashok Soota said that we have missed a revenue growth target by 1.3% due to right shifting of some Q4 revenues. Can you elaborate on the right shifting bit? What does that mean, and what do we gauge from it?
So just to give you on the guidance, we had said we will grow by about 25% in constant currency terms. And we have done almost 23.7, 24% for the year. So that's the basis on which we said that we have missed guidance by 1%. But at the same time, hand in hand, my guidance for EBITDA, which is profitability, was 22 to 24%, whereas for the 12th quarter in succession, we have beaten that and we have delivered 26% EBITDA. So profitability has been above guidance, and there has been a slight drop on the revenue guidance part. Now, the reason for this revenue guidance the slight miss, was in Q3 we had a surge in vacations, which was something unanticipated, because I don't want to use the word revenge holidays, but there were quite a bit of holidays that people had accrued that got taken. And it was a little bit of unplanned surprise that we were taken by. And in Q4, things started looking up. As you will see, we signed up 17 new logos. We had a nice pipeline of customers and prospects. What happened is those businesses have taken time, and now they are signing up as we look into Q1. We are in Q1. They are signing up, and that's what was meant by right shifting of revenues, because you typically take couple of months to once you book to work, bill, and then recognize these revenues. So that's happening in Q1, which is why our commentary on the forecast for Q1 and for the year is positive. While that be so, I would like to just highlight that our performance for the year, though we missed the revenue guidance by 1% or 1.3% to be exact, our profitability has been par excellence, and it's again been at 26.2% and a growth of 29%. If you look at it, EBITDA and at PAT level, it's about 28%. So it's been growth on all fronts.
Okay. My next question is to you, Joseph. You in the statement said that there's a marked improvement in the pipeline, the deal velocity in the second half of the quarter, setting us up well for the first quarter in FY24. That commentary, if I may say, that's contrary to what we have seen at some larger IT firms. So what exactly changed for you in the second quarter, especially in the second half of the fourth quarter, especially because we saw the banking crisis rearing its head in the US, and there's a general slowdown. So what exactly happened in the second half of the fourth quarter?
So, if you remember, even in January, when we declared our results, we did mention that we were seeing quite a few opportunities. And just going back to what Venkat talked about, right shifting, what happened for us is that many of the opportunities that we're discussing with our customers, their budgets, which typically would have got decided in November, latest December, that decision got pushed out into January or February. And most of them got their budgets in end Jan, mid-February, and they were able to make their decisions on projects in the February-March timeframe, which is what I meant by we saw an improvement in deal velocity. And as a result, we had 60 new logos closures in Q4, which is among the highest that we've had. Again, in several of our existing customers, we've had opportunities that either closed in March or closed in the first half of April. And I think there are a couple of factors out here. We see that some of the digital initiatives that our customers have started, they need to either sustain them, or in some cases, they have to start these initiatives. And given that we are a pure play digital player who has been working with them, helping them with various POCs, pilots delivered in the past, they've come back to us and relied on us to help them with with these initiatives, and that's what has led to the positive sentiment. And I must say that even in April, the month that went by, we had 2 pretty large deal closures from the pipeline that we had. So we've started the quarter off quite well. These should ramp up over the next couple of months and give us growth into Q2 as well.
So you're definitely seeing some delay in deal closures, but it has sort of worked out for you, for now at least.
Yes, I wouldn't say delay in deal closure. I would say delay in budget allocation. The budgets that should have got allocated, because the deal, I think the customers, the owners of those projects, they had to do it, but the money that they could use or spend, that got delayed. That's how I would look at it. Because it wasn't that there was a question around whether these initiatives had to be executed or not. It was more around, have you got the budget? How is the macroeconomic factor? I think the senior management was waiting to see if there's any signs in the early part of the year in January. And I think once they were a little comfortable, as I said, they look at the macroeconomic factors, the geopolitical factors, and they sort of reconciled these and decided to finalize their budget and fund some of these initiatives.
Okay. Venkat, you have retained your FY24 guidance. This, when you see bigger peers like, say, Infosys or somebody else, have reduced, not reduced, it's not as big as what they had grown in FY23. So what is driving your bullishness in FY24?
See, while everybody expects us to be in line with the industry, there are also company-specific factors. We are not a $10 billion, $20 billion corporation. And when they talk about 10% revenues, we are talking about adding $2 billion to their top line, and which means that's equal to 10 Happiest Minds.
Okay.
So we closed about 177 million. We are humble about it. And what we did is looked at our own kind of business that we are doing. And let me just caveat that we were fortunate, Tushar, to be a great deal. 21-22, when COVID happened, we were fortunate that we didn't have so much of exposure to the travel and tourism, hospitality, vertical. We had 0.5%. It was not by design, but that was it was what it was at that point in time. And in 23, we got, because of our high offshore element, we got quite a good headwind or tailwind from the currency standpoint, and we didn't have any Eastern European operations. So there again, we were lucky. Now, in the current year, BFSI is about 10.5% for us, and this is not the traditional, BFSI segment work which the biggies do today. And so, to that extent, when BFSI cracked in the last quarter in the US, we were not so much affected. So, if you look at it, other than assessment in the market, when you look at the specifics, we were not affected. And like Joseph mentioned, the sentiment has an effect on, people reprioritizing. Oh, should we wait for a couple of months to see how things pan out? And that's what happened in Q4. And they quickly came back and said, we have to get back to doing things what we had planned out. And that's how the budgets got released. And we are looking at a decent Q1 and a good base for the next year, Q1 and the next year.
But there is a decline in contribution of your US business to your overall revenue, while India operations have improved. So are you seeing a consistent or sustained change in the mix going ahead?
Just to talk about the mix in absolute terms, no geography has come down.
Okay.
India has obviously been, it's been improving, and we have been focusing on India as a geography even before, everybody says now this is the fastest growing economy and you should focus on it. We have been focusing on it, and we have been getting good competitive rates, which is how we are able to maintain our profitability even when our rates, we are doing about 15% from India. So India is a focused geography. US has continuously been the largest geography. And, we did a small acquisition recently, and that's got one or two customers who are from the US geography, and that slowly moved the percentage shift towards US. Otherwise, all geographies are doing well. There has been some bit of adjustment in the Middle East versus Europe. Those are things that happen. But in absolute terms, we are seeing traction in all geographies.
Okay. Joseph, let's talk about people now. Your attrition improved to 19.8%, but utilization levels have dipped. But your deal making has improved. So, what exactly is happening here? So, your deal
Sure.
making has improved, your utilization levels have
Yeah.
fallen, but and attrition itself has fallen. So, what's happening here?
Yeah. So as you rightly pointed out that, we did see a dip in attrition in Q3 beginning, and in Q4 that number fell further. And if you look at Q4 standalone on an annualized basis, the attrition is back to what we historically have had. And you'll see in the next couple of quarters, attrition coming back to the 15, 16, maybe even 14% range that we've typically operated at. On the utilization front, I think the big fact out here, Tushar, was the campus batch that we brought on board in August. So they were going through their training up till Jan or so, and therefore they were not included in the billable headcount. In February, they got allocated to the business units and the centers of excellence, and we moved this number into the billable headcount. And this is around, totally 300 in number. This has resulted in, in the utilization dropping from around 80% to around 75%. Again, one thing I should point out is that the utilization that we were operating at 80% is a very high one. Given our size and the plurality of skills that we need, it actually is a business risk. We very often leave money on the table, and so we are comfortable having our utilization maybe 1% or 2 higher than what we are right now, but 80% is too high, and probably 76, 77% is something that we would like to target. Again, the campus batch that I talked about, they've started shadowing and getting allocated on projects, and over the next 6 months or so, they will start contributing to revenue without much of a additional cost. So that's the positive part of the utilization story.
Okay. So what are hiring plans for FY24 against that backdrop? Freshers, are you looking to hire freshers? Are you looking at more senior level hiring for FY24?
So for the current year, we're looking at net headcount addition of 1,300, 1,300, Vishal. Of this, approximately 450 is targeted from campus, and the rest will be laterals. We've completed the interview, offer rollout, all of that for the campus batch. We expect them to join us in the next couple of months, 2 to 3 months in batches. And as we speak, we're doing various, assimilation and other activities, engagement activities to stay in touch with them. Hopefully, we will have all of these people on board in the next 2 to 3 months.
All right. Mr. Venkat, just a bit of news that came in yesterday. There's a company called Chegg, an edtech startup in the US, that said that ChatGPT is killing its business. You draw nearly 25% of your revenue from edtech. How do you see the impact of generative AI on your business, given this commentary from a US-based listed edtech company?
I would like to turn this over to Joseph to give you a first-hand experience.
Okay. I've been meeting with a lot of edtech companies, and I think there will be, it can help. It can be a positive or a negative depending on how customers, adopt this technology, especially in the edtech space. If you look at Chegg, they were dependent on a lot of their course and textbooks being available online. And once you do that, with a technology like ChatGPT, which can just scrape all of this, you lose control over your content. And so what many of the edtech customers that I've been talking to, what they're doing is to make sure that they wall off their content and not let it be open, similar to what Google did with some of the other things. They don't want that happening out here. But at the same time, I think ChatGPT can allow customers to really change the way students interact with professors, to change the way you have your courses aligned for students. You don't have to have standard set of courses. You can make it much more personalized, the way education is given to students. So I think all of our customers are looking at ChatGPT, as to see how they can leverage it. A lot of discussions happening with a couple of our customers. We're discussing how we can do POCs for them in the edtech space. Outside of edtech, with a couple of customers, we already have LOIs to do POCs for them. So we have our CTO forming two task forces. One is to look at how our customers can adopt ChatGPT and generative AI, and then another task force to see how for our own developer community, how can we improve their productivity, quality, and take some of the mundane tasks out, so they can focus on more of architecture, design, and make sure that our code is of higher quality than what we have right now. So we're looking at both of that. There's a fair bit of investment being made on ChatGPT, and I think we believe that it will be a transformative technology, which can be, if we play it right, which can really help both us and our customers.
All right. Also, again, Joseph. So actually, we have gone through all of this thing. So okay. Thank you, guys. Thank you for joining us today. It was a pleasure talking to you. Thank you, viewers, for joining us today.